Welcome back. Today we're looking at a detailed analysis report called SOFI Just Broke Out. Rocket, why $30 is just the beginning.
Yeah, this one argues that SoFi is kicking off a massive bull trend after its Q3 breakout, using financials, upgrades, the whole picture.
Exactly. So let's look closely at the framework here and see how we can make this already strong analysis even sharper. Okay, so first up, the report makes a really compelling case for a fast move up to what, $35 or $38? It highlights clearing that big 28-29 resistance zone. You've got huge buying volume and then the short squeeze. Short interest is down to around 12%.
All the momentum indicators are flashing green. It's a pretty clean picture.
It is.
But while the report really confidently projects that swift path to $35, it needs to better integrate the immediate technical risks.
Okay.
So the analysis does mention a critical counterpoint, but it feels like an afterthought almost.
What do you mean?
Well, in the section on stock price stats, it notes the relative strength index, the RSI, is elevated overbought, and it suggests a potential for a brief consolidation.
Right.
The weakness here is that this crucial signal is just treated as a note in parentheses. It's not really integrated into the main forecast.
So if the stock hits a wall, someone reading this might feel a little blindsided.
Exactly. It creates this minor logical gap between the super aggressive short-term call and this, acknowledged overbought condition.
I see the tension there. I mean, the whole point of the analysis is this momentum trade. If we start flagging an overbought RSI too heavily, doesn't that sort of undermine the core thesis?
That's the challenge, right? And that's what the analysis needs to solve. So the suggestion is to just dedicate a little more space to reconciling that aggressive momentum with the overbought signal.
So you're not killing the idea, you're just managing expectations.
You're managing expectations, you're turning a risk into a defined checkpoint for the reader.
Okay, so we keep the aggressive forecast but give the reader a kind of contingency plan.
Precisely. For concrete examples, well, you could provide some conditional context. You could specify what indicator would signal that consolidation is already priced in.
Like what?
Maybe a specific price floor holding above the breakout level on, say, the 4-hour chart. Or you could define a volume level, like what percentage above the 20-day average would confirm the upward move despite the high RSI.
Ah, so you give them an objective thing to watch for. It's not just a feeling.
Yes. It assures them the trade is still valid above a certain line. It shifts the focus from the RSI is bad to the RSI is high, but look, the market is confirming the strength by holding level X.
I like that. That's much more useful.
And alternatively, you could just acknowledge that the next big resistance point, let's say the 52-week high at $32.73, that might be the natural spot for this consolidation to happen.
So you build the risk right into the roadmap.
You build it in. You basically say, look, expect a fight here, but if we break through this level on high volume, then the path to $38 is wide open. It turns the risk into the next test of conviction.
That's a much more sophisticated way to handle it.
Very smart.
Okay, let's pivot to the fundamentals. The technicals are great, but the story has to hold up.
Right.
Like here is the clear focus on the financials. 8th straight quarter of GAAP profitability. What was it? $139 million in net income.
And the diversification. It's not just about lending anymore.
That's the key. Now, the market is obviously buying this story. I mean, look at the valuation. The whole justification for that high PE, a forward 2026 PE of 45, it all hinges on the 2026 outlook.
Where EPS is supposed to nearly double to between 60 and 70 cents. And a 45 forward PE for what's still partly a financial company? That is huge.
It's massive. It means the market is pricing in near perfect execution.
Which leads us right to the next point. To really substantiate that high PE ratio and that doubling of EPS, the analysis needs to give more specific structural detail on the operational path that gets them there.
You're talking about a mechanism check. How do they actually do it?
Exactly. The weakness is that the analysis just chalks up the future EPS growth to operating leverage kicking in. It notes the target ROE is 20%, which is way up from the current 9%.
So it's rich on the outcomes.
It's very rich on the outcomes, but it needs to explicitly link the scaling of the tech platform, Galileo, and Technisys to those profitability goals. It's relying on this kind of general concept of leverage without really detailing the engine that's creating it.
And that operating leverage is, it's the difference between a great investment and just a speculative bet, especially in fintech.
Absolutely. If you're going to argue for a 45 multiple, you have to convince people that this leverage is structural and, more importantly, predictable.
So the suggestion here would be to flesh that out more?
Yeah, strengthen the logical bridge, connect the current Q3 growth drivers, like financial services and the tech platform, to the huge margin expansion that's required to hit those 2026 EPS targets. We need to see how the profit is being unlocked in a non-linear way.
Can you elaborate a bit on that, the nonlinear part?
Well, think about it this way. Traditional lending is capital intensive. Growth it's kind of linear with your inputs. You need more capital, more customers.
Right.
The tech platform, though, that's a B2B service. Once that infrastructure is built, every new client you add brings in this predictable, high-margin revenue with very little extra cost. The story changes from "we lend money well" to "we provide the plumbing for other people to move money."
And that's a fundamentally different risk profile.
Completely. So for concrete examples, the analysis should do a brief mechanism check. Show how their financial services productivity loop, cross-selling to existing members, feeds directly into that nonlinear growth.
So you're saying it should explicitly compare the margins?
Yes. Mention the specific margin profiles of Galileo and Technisys. Show how their B2B model creates this scalable, high-margin revenue compared to lending. That comparison is what validates why this stock deserves a tech valuation, not a bank valuation.
Okay, so the mix shift is the real driver of the EPS jump, not just the market getting better.
Exactly. And building on that, the report mentions the ROE is around 9% now, heading for 20%. That is an enormous 11-point leap.
A huge leap.
The analysis has to detail the specific efficiency gains that drive that. Is it better use of their warehouse facilities, lowering their cost of funds? Is it lower customer acquisition costs because the cross-selling is working so well?
Pinpointing those internal improvements.
Yes. It transforms a future target into something that's a function of demonstrated operational skill. That's way more powerful and helps justify that big multiple.
All right, let's talk about the overall arguments, its robustness. The core narrative here, as I see it, is that Wall Street consensus is flipping from skepticism to chase mode.
Yeah, and you see firms like Needham raising their target to $36. The analysis itself is a statement about that shift.
It is, but that's a powerful story.
It is, but while the report is a very effective, bullish thesis, it would be more robust if it integrated and then dismantled one or two of the old arguments that fueled that skepticism in the first place.
Okay, so deal with the historical baggage.
You have to. The weakness is that the breakout thesis is so data-heavy and forward-looking that it kind of overlooks the historical concerns analysts had when the stock was stuck between, 14 and 18.
Right.
A purely bullish report might not satisfy a technical reader who remembers those headwinds and needs to know they've been solved for good. It's like selling a classic car. You have to show the buyer where the rust used to be and prove that you fixed it permanently. Otherwise, all they see is the old damage.
So you acknowledge the old ghost risks instead of just ignoring them.
You acknowledge them, and then you use the current data to prove they're gone. That makes the whole analysis almost counter-argument proof.
So the suggestion is to briefly bring up a key counter-narrative, like, say, their historical dependence on student loans.
Or interest rate sensitivity. Yeah. And then you immediately use the Q3 numbers to show definitively how that concern has been taken care of.
Okay, so give me a concrete example. How would you do that?
Well, you could explicitly address that historical fear about interest rate sensitivity. You contrast that past vulnerability with the new reality. The tech platform and financial services segments are now driving most of the growth.
Which proves the company isn't just a one-trick pony tied to interest rate cycles anymore.
Exactly. You resolve a major systemic risk that hung over the company for years. It's turning a historical liability into a demonstrable strength using their latest performance.
What about stability? I mean, that's a common concern with fast-growing fintechs.
That's a great point, and it's critical. Is there a risk that this focus on hypergrowth overlooks the need for capital stability? The analysis should tackle that head-on.
How?
By acknowledging their strong liquidity position. Point to the total capital ratio of 16% and mention that it's well above the regulatory minimums. That proactively answers any questions about their financial foundation that might pop up during this aggressive growth phase.
It shows the growth isn't reckless.
It shows the growth is built on a solid foundation. And when you're arguing for a 45 PE multiple, that is absolutely essential. The analysis moves from just being optimistic to being fundamentally secure.
Okay, so to summarize our thoughts on this analysis, SOFI just broke out. We covered 3 main areas to really enhance it. First, we need to integrate those technical risks, like the overbought RSI, right into the forecast. Define some conditional criteria to manage expectations, but still keep the bullish thesis.
Right. Second, We need to provide a more detailed justification for that massive operating leverage that's supposed to double the EPS. That means getting into the weeds on the high-margin tech platform and that 11-point jump in ROE.
And third, we focused on making the whole argument more robust by proactively addressing those historical counter-narratives.
Like interest rate sensitivity and capital stability, the things that define that long consolidation period.